Hey, hi everyone. Welcome to another video in our hedge fund strategy series. So, today we are going to discuss about the quant model strategy. So, we already discussed about global macro hedge fund strategy, and then we also discussed about yesterday the contra trading strategy. Today, what we will discuss is the quantitative hedge funds, which basically refer to hedge funds which deploy advanced mathematical models. And these mathematical models generally comprise of statistical models and computational models, and use a lot of statistics probability to come up with mathematical models that can give signals which can be traded upon to make profits. The quant hedge funds also use massive data processing. They collect data from a lot of places, and they try to find patterns and anomalies which are repeatedly occurring within that data, and then backtest those particular anomalies or patterns and see if they're profitable, and based on that they deploy those models to make profit. So the main two quantitative hedge funds which are very famous in the world are Renaissance Technologies and DE Shaw. So Renaissance Technologies is the flagship fund is called Medallion Fund, and DE Shaw is DE Shaw Composite or Oculus. It is. So Renaissance Technologies is very popular. It's able to generate 66% annualized returns every year. That's the highest that any fund has been able to generate till now, and it's all mathematical and statistical. So if you see the edge of this fund, the edge is proprietary signals which come from obscure data using machine learning, statistics, and physics. Okay, so that is the edge of this particular fund, and they employ the employees who work in Renaissance Technologies are mainly PhDs in physics, maths, and computer science, and very few with finance background. Okay, whereas D Shaw is able to generate 10 to 20% annualized returns, and it uses multi-model statistical arbitrage and predictive analytics. Okay, it employs quant scientists, computer scientists, and linguists, and as well as traders. So coming to Renaissance technologies and even DE Shaw, they highly rely on the first model, which is a core quant model. It is called statistical arbitrage. So what this particular model does is it identifies pricing inefficiencies in correlated assets, and they trade. The strategy that is used is mean reversion or conversion. Okay, so the price, if it is going away from the mean, uh, then it has a tendency to reverse to the mean. So that is the what is called as the mean reversion strategy. So if the price has gone too far from the mean, either in the positive direction upwards or downwards, it will definitely come back to the mean. So that is what is a mean reversion. So, and this particular technique or the statistical model is used by the quant hedge funds to identify the pricing inefficiencies in correlated assets, and yeah, this works a lot in commodities market, and yeah, so this is the main strategy, and it is done in a high frequency trading manner. From milliseconds to multi-day patterns are identified and traded upon, and both funds heavily rely on this particular model. Okay, techniques used for this are pairs trading. Okay, pairs trading, you could use basket arbitrage, you can use high frequency implementation of micro arbitrage strategies can be used. Okay, so this is the first one. So yeah, coming to Renaissance Technologies, it initially started with mean reversion strategy, and it made a good amount of money. But when its mean reversion strategies started failing, then what it has done is it has uh, and there was a limit on how much can be traded upon in the commodities market. Sure. Yeah, commodities market. So yeah, when the Renaissance technologies found mean reversion strategies were uh, failing or not generating so much returns as they used to. Then they have pioneered this entire machine learning models. Okay, so machine learning models deployment in the financial markets was first or done by Renaissance Technologies. So, who is this guy who invented this Renaissance fund? So, let's talk about that first, so that we know what we are talking about. So, James Simons is the person. So, he is uh, was a professor at MIT, and he was a former NSA code breaker, and he was an excellent mathematician. And his emphasis was on pattern discovery. Okay, and David Eshaw is a PhD in computer science, and he was an early AI and NLP researcher. So this guy is from Columbia. He used to teach at Columbia. He used to teach at MIT. Okay, and the main fields that they use to develop these models are statistical physics, information theory, Bayesian inference, and complexity science. Okay, that's their academic background and roots. So coming to our techniques, so we discussed about mean reversion or statistical arbitrage, and identifying pricing inefficiencies in correlated assets that being used by both the funds heavily to make money. Then yeah, once the profits decreased in the mean reversion, then machine learning models were deployed first by Renaissance Technologies, and this machine learning models, what they do is they predict the price movements, and they forecast the order flow imbalances, and they model market microstructure and adaptive position sizing. These four use cases they cater to. Predicting price movements is the main one. Forecasting and using all these four use cases, signals can be generated, and trades can be executed to make money. This is what is the edge that the company has. These are the different algorithms or mathematical models: random forests, neural networks, reinforcement learning, which are used to basically trade. And these are basically prediction systems or forecasting systems, and these mathematical models are behind them. And these mathematical models and prediction give an edge to this prediction and forecasting systems. Okay, so that's the second one. Basically, machine learning models deployment to have an edge and to trade and generate trading signals to trade. The third one is signal mining. So this is massive data is basically stored, and the data sources that are stored are pricing data, like historical pricing data, volume data, fundamentals related data is stored. Apart from that, even satellite imagery data, weather data, shipping logs data, Twitter sentiment, even data basically from websites, patent filings, academic papers, even restaurant reservations, and social media news. All this data is basically collected, and then the techniques of national natural language processing, um, the time series anomaly detection, semantic similarity, and topic modeling in auto ML pipelines are used to generate signals, basically. So, trading signals by mining this massive data. And Renaissance Technologies is a pioneer in this one also. It is rumored to have maintained terabytes of cleaned data going back decades, stored in proprietary formats. Okay, so this is the third technique, where it's basically signal mining massive data. We already discussed about statistical arbitrage as well as the machine learning models. The fourth one is market microstructure model. So this tries to you enter quickly and you exit quickly. So ultra short term trading it is called, and this ultra short term trading and the prediction of order book dynamics. So this is what is used to make money. Medallion fund uses this. It is termed by a name called basically it relies on probability theory, and it is a systemic probability trading mechanism. Okay, and the different techniques are used here: optimal execution algorithms, latency arbitrage, limit order booking modeling. These are used to um, do this ultra short term trading, and the trade is done on a particular trade which has a probability of success more, as well as risk to reward properly aligned to it. Okay, then yeah, DE Shaw does something different. DE Shaw uses macro modeling also. It's not purely mathematics that is done. DE Shaw uses combination. It uses multi-factor models, so it uses things like value, which is basically price, and the momentum. What is the momentum? Quality, the sentiment, news factors. News also it uses short-term technical momentum and reversal factors, and regime switching and adaptive beta filters. Okay, so it basically blends fundamental signals also with the mathematical models, and it's like a hybrid quant model compared to Renaissance. Renaissance purely relies on mathematical models, and has its edge in those mathematical models. Yeah. So what makes these particular models work is signal density. So thousands of microsignals are generated, which give them the edge to make profit. In case of Renaissance, in case of DE Shaw, very few signals are generated, but these are very strong signals because they use both finance and math. Data quality, so they have a lot of obsessively clean, normalized, denoised data, and DShaw uses structured and unstructured data to identify patterns and signals. So DShaw has something called as a ghost patterns identification. It identifies its models identify uh, the statistical anomalies which occur frequently. Okay, and those statistical anomalies, when they occur frequently, you can make money of those particular statistical anomalies. Okay, yeah, that is one thing. And yeah, even Renaissance technologies uses not only mean reversion, it also uses linear regression techniques. um, okay, and yeah, AI also, and ML also it uses apart from high frequency trading. So they have the best in class execution algorithms, and it is strong on execution and macro modeling. Yeah, so these models relearn from outcomes. These feedback loops are there, and this is human plus AI oversight. The show has culture of Renaissance is pure quants, few finance people. This is mix of academia, finance, and engineering. The show. Okay, so this is an example. ChatGPT has generated for a Renaissance micro signal. So if you see this, um, price spread between SPY and IVV. So it is when signal is greater than 2, it is shorting SPY and long on IVV. If it is less than -2, it is long on SPY and short on IVV. And these companies like Renaissance may use such 1 lakh plus micro signals and blend them to get ensemble weighting. D show uses this multi-factor model. So zero point 0.4 into value, zero point 0.3 into quality, zero point 0.2 into news, zero point 0.1 into means reversion. So this is their model. This is alpha score, and if alpha score is greater than threshold, enter this position. Okay. So these are the models, guys, and the ghost patterns. So ghost patterns, I told you, is used by DE Shaw, which identifies statistical anomalies. Okay. Other than this, there was a fund called LTCM, Long Term Capital Management, which made a lot of money, around 40% when it was successful. But it failed because of Russian bond default. Russian government has defaulted on its bond payments, and that's what has made that fund go bankrupt. And it assumes a normal distribution, and it assumed a normal distribution, and one black swan event like the Russian government defaulting on its payments has totally wiped off that particular fund. DE Shaw, to counter that, uses it doesn't assume the normal distribution. It even counters for the outlier uh, black swan events, and models them also, so that that is also taken into a factor to from a risk management perspective. So that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye.